Welcome to this official sector panel on the transition from Libor to risk-free rates. The authorities globally consider that the transition away from Libor is an essential task and a priority for the G20. And this year is a critically important year in the transition. To discuss the key issues for the international capital markets, I'm joined by senior representatives from 4 of the key official sector institutions involved. Edwin Schooling-Latter from the UK Financial Conduct Authority, the FCA, Nate Werfel from the Federal Reserve Bank of New York, Roman Baumann from the Swiss National Bank, and Thomas Vlasopoulos from the European Central Bank. I'm Paul Richards from ICMA, and I will be moderating the panel. The 3 main areas that we're planning to discuss on the panel are: first, progress on the transition from Libor to risk-free rates in different Libor currencies and jurisdictions, and the remaining challenges, including tough legacy. Second, international coordination and alignment. And finally, key messages from the official sector to market firms in the run-up to the end of this year. First of all, we're going to discuss progress so far in the transition in the different Libor currencies and jurisdictions, and the remaining challenges, including tough legacy. Edwin, please could you give us your view on progress in the transition from sterling Libor to SONIA and the remaining challenges as you see them? Over to you.
Thank you very much, Paul. Well, I think the story of progress in transition is really told best by the numbers and by the data that you can see. And the good news is on the sterling side that where the bond market led, other markets have each in turn followed. So as you all know, actually for a long time now, new issues of floating rate notes in sterling have been referenced to SONIA instead of sterling. We've also now seen a very decisive shift of the center of gravity in terms of liquidity in the swaps market from LIBOR, sterling LIBOR to SONIA. The most recent big challenge was in the lending market. There was a target to cease all new LIBOR-linked sterling lending from the end of March 2021. We've been receiving regular data reports from all the main lenders, and that is showing that that milestone has been successfully achieved. So in the lending market too, a smooth transition to risk-free rates compounded in arrears. The next market to follow is going to be the futures market. We see a very significant build-up of SONIA liquidity there. I think we'll see that also flip over to SONIA from LIBOR before the end of the year. So where are the challenges? I think on the sterling side, those are in pockets of legacy. Now, as we all know, on the cleared and uncleared swap side, this challenge has been effectively addressed through the rules of the clearing houses and the very significant take-up of ISDA's protocol. So we've got 97.5% plus of derivatives markets that we know will transfer smoothly to SONIA at the end of this year. But the challenges in lending and in bonds are a little bit different, because that obviously requires contract by contract attention. On the bond side in particular, that's through the mechanism of consent solicitation. I should say there have been some notable successes and a continuing stream of notable successes on that front. I think we're pushing up towards a good third, perhaps a little bit higher in terms of values outstanding that have now been converted through consent solicitations. That proportion is a little bit lower if you look at number of bonds, but that process, consent solicitation, is going to be an important part, I think, of our lives going forward. There are, of course, some plans we have clearly set out to consult on requiring publication of a synthetic sterling LIBOR at 1, 3 and 6 month tenors, but that's not a permanent solution. So particularly for the longer dated bonds, it does not obviate the need to go through that consent solicitation at some point.
Thank you, Edwin. That's a very, very helpful explanation. I'm now going to turn to Nate Werfel from the Federal Reserve Bank of New York. Please, could you give us your view on progress in the transition from US dollar LIBOR to SOFR and the remaining challenges as you see them in the US?
Thank you, Paul. And let me start by thanking you for having me on this panel and for continuing to highlight the critical importance of the global transition away from LIBOR. I should also start by providing the usual disclaimer and say that my comments are my own and don't represent the views of the New York Fed or the Federal Reserve System. In answer to your question, first, I'd highlight some areas of significant progress in the transition away from US dollar LIBOR. First, we've seen announcements over the past 6 months that have provided clarity on exactly how US dollar LIBOR will end. We now know when US dollar LIBOR panels will cease, when new use of US dollar LIBOR should stop, what spreads will be applied in legacy contracts that fall back from LIBOR to SOFR, and various tools are now in place to reduce the risks around legacy contracts. The ISDA protocol is in effect, allowing market participants to incorporate robust fallbacks into legacy derivatives. And LIBOR legislation has been signed into law in New York State, and that addresses the toughest of the legacy contracts that don't have workable fallback solutions. The Federal Reserve and the ARC also support efforts around federal legislative solutions. Adoption of SOFR, the ARC's recommended alternative to LIBOR, has increased in some important markets as well. SOFR derivatives are well established and are expected to continue to grow. The majority of floating rate note issuance is now SOFR based. Fannie Mae and Freddie Mac have begun accepting SOFR ARMs last year, and they no longer accept LIBOR-based adjustable rate mortgages. But there are some key remaining challenges. Those include in the business loans market, which has been slow to transition from LIBOR, and that's probably not too surprising given the size and the diversity of products in this market in the US. There's been hard work underway, but it will require banks and borrowers to come together. Non-financial corporates have asked for a range of SOFR offerings from their banks, and a group recently sent a public letter, to regulators asking for further engagement on this topic. And I would note the work that the ARC has done to explain how forms of SOFR can be used, including in the loans market. The second area I would highlight as a challenge is that while SOFR derivatives are growing, we are still seeing a very significant amount of activity being conducted in LIBOR derivatives. And the fact is that under the ISDA protocol, as Edwin mentioned, these contracts that mature after mid-2023, they're really SOFR exposures already. So we know there's a tremendous amount of SOFR liquidity that's already sort of sitting out on the horizon. And what we need to see is for the actual trading activity and the quoting switch over to SOFR sooner. And we've seen that such a switch is quite helpful in the UK. And the ARC believes that a step similar to this could happen as early as this summer if market participants act quickly. Fortunately, there's efforts underway by the ARC and by a subcommittee of the CFTC's Market Risk Advisory Committee to make a switch in the convention for quoting to SOFR. And they hope to have more information on that very soon. The great thing about this switch in the summer would be that we really move away from the financial stability risk that is LIBOR derivatives. These make up the vast majority of LIBOR exposures, and we'd be firmly establishing those in a risk-free rate SOFR. Importantly, this is also one of the key market indicators that would allow the ARC to recommend a forward-looking term SOFR rate very soon thereafter. The ARC knows this is an important tool in the toolkit for the transition, and the ARC just recently selected the CME group as the administrator it plans to recommend for a forward-looking term SOFR once these market indicators have been met. And this will allow market participants to plan ahead for the formal recommendation of the CME SOFR term rates. Again, we hope that could happen as soon as early this summer.
Thank you. Roman, I'd like to ask about progress that you've made already on the transition from Swiss franc Libor to SARON, and you are able to complete the process by the end of this year. How have you managed to achieve that?
Yeah, thank you very much, Paul. A lot of the important points have already been mentioned by Edwin and Nate. I'd like to focus on a couple of Swiss-specific points. There were the two major areas in our case: loan products and derivatives market. So, with regard to the loan products, the transition is very well underway. So, as most of you might know, there's the floating mortgage market, or floating mortgages are an important component in Swiss francs. So we always had a large share of Libor-based mortgages, and Switzerland is unique in a way that, and I will come back to you on that, and we'll come back to that a bit later. There won't be a forward-looking term rate in our market. Our national working group has made that clear from the beginning. So all our products have to be on a compounded SARON basis. And looking at the mortgage market, all major banks have launched such products. In the meantime, they have been very well received by clients. So this clearly shows it's not only suitable for professional investors. It only works having a compounding in areas also works very well in the retail segment. So this is definitely one important part. Based on a survey done by FINMA, or regularly done by FINMA, our regulator, the vast majority of new Swiss franc loans is already based on SARON. So the transition is very well underway in that regard. The picture looks a bit different on the derivatives markets. Unfortunately, we're not as far as our UK colleagues, as Edwin has mentioned in his remarks. Volume in SARON-based swaps are gradually picking up, but there's still active trading going on in Libor-based products, especially if you look at it on a DV01 basis. So especially longer maturities are still actively traded in SARON-based products. Plus the Libor-based, the Libor-based swaps. Also, the Libor-based swap curve still plays a very important role in our capital markets. So actually virtually all of the new issues are still priced off the Libor swap curve. Also, the secondary market trading happens based on the Libor swap curve. So we still need to see a move towards the SARON swap market, but we're confident that's going to happen in the next couple of months. Also, based on the FINMA has laid out a roadmap based on the FSB roadmap that has been published, and it is expected that by June no new contracts will be based on, or should be based on, Libor. So we should see some major progress on that front. One area where we are a bit luckier than our colleagues is this tough legacy topic. We do not have the same amount of tough legacy that are present in the UK or the US. It's also the reason why there won't be a synthetic Libor in Swiss francs. So as you mentioned, Paul, clearly our transition will be fully complete by the end of this year.
Thomas, perhaps I could ask you whether we're all right in thinking that the immediate priorities in the EU are to replace Ionia with ESTR and to include ESTR fallbacks in your IBOR transactions. Perhaps you could give us all a perspective on that.
Yes, thank you, Paul. Indeed, a benchmark reform in the euro area has been slightly different than what Edwin, Nathan, and Roman talked about. And indeed, the two aspects that you highlighted are the ones that are relevant. So let me say a couple of words on each of these points. So first, on the transition from Ionia to Euro STR. As we know, the termination of the publication of Ionia is coming on the 3rd of January 2022, and that's approaching fast and leaves just a few months for users of Ionia to complete the transition to Euro STR. So we see this transition gathering pace. So if I can give you a couple of examples, in the OIS market, we see a tripling recently of the share of trades that are based on Euro STR. So in April, that was 15% compared to only 5% at the beginning of the year. But of course, this also shows, despite the progress made, that there's still quite a long way to go. We also know that Clearance, as previous speakers also mentioned, have put forward plans for the conversion of the remaining stock of, in this case, Eonia-based contracts in October, well ahead of the benchmark discontinuation, which is another positive sign. And we also see, looking at our MMSR data, that banks' reliance on STR in their day-to-day business is increasing. So, for example, we see that in the call accounts. Nevertheless, as I mentioned before, the transition still has a considerable way to go, and therefore we strongly encourage market participants to continue and even accelerate their efforts to transition to EUR-STR to avoid any operational or legal difficulties at the start of next year. And to help market participants use EUR-STR, the ECB has recently started publishing, as of April this year, a compounded EUR-STR average rate, or a series of compounded EUR-STR average rates. And in this way, we responded to calls from the industry to provide a so-called golden source for these computations so that they can be used more easily in contracts. And this brings me to the second aspect of euro area benchmark reform that you mentioned, Paul, the introduction of fallback provisions when using Euribor. Now, unlike Libor, Euribor is not scheduled to be discontinued, of course. However, there is always the risk of possible future discontinuation of Euribor. So to address this risk, market participants are in fact required to include workable fallback provisions, in their contracts. Now, the industry working group on euro risk-free rates earlier this month released a set of recommendations in order to support market participants in their contingency plannings and help promote some market consistency in addressing this fallback provision issue. And the recommendations cover three main aspects. The first one being fallback triggers. So when do fallback rates actually apply? The second has to do with the choice of the fallback rate itself and the recommendations in the waterfall approach that is put forward there. And the third one has to do with the spread adjustment, the compensation for the difference between Euribor and the fallback rate. Now, it's of course up to the Euribor users to consider these recommendations, and if not already done so, to make sure that the contracts have clauses to fall back on in the event of Euribor discontinuation. And let me also touch on the impact that benchmark discontinuation may have on the tough legacy contracts and how this is being tackled in the case of the European Union. So earlier this year, the EU benchmark regulation was amended, and this gave powers to the Commission, to the European Commission, to designate a statutory replacement rate for critical benchmarks that are being discontinued. The statutory replacement rate will apply only to those contracts where there is no contractual fallback or sufficiently strong contractual fallback provision. Importantly, this also applies to third country benchmarks, such as the Libor, to the extent that its discontinuation would significantly affect the functioning of EU markets. And to close, let me mention that at the moment, the focus is on Swiss franc Libor contracts, because in some EU countries, like Roman mentioned, of course, for Switzerland before, but also in some EU countries, there are quite a few mortgages that are contracted referencing Swiss franc Libor. And the Commission has recently concluded a public consultation on designating a replacement rate for Swiss franc Libor. And it's currently at the stage of assessing these responses in order to issue its decision.
Thank you. Perhaps we could move on to the international coordination and alignment, which I know is important for the authorities and in which you and colleagues have been heavily involved. Please could you say a word about how that works and how international alignment is working?
Yeah, thank you, Paul. That's a great question. So Libor is, of course, used or has been used across the globe. So right from the beginning of this initiative, it has been a global undertaking involving authorities in all the jurisdictions for which a Libor reference rate, for whose currency a Libor reference rate is published, and it's going to continue to be a coordinated, globally joined up effort until we have completed it successfully. And that, of course, may feel much more visible to me because I'm in the heart of that dialogue with other authorities than it perhaps does to market participants. So we often get questions about this. But you can see the mechanisms that we've been using in terms of the Financial Stability Board's official sector steering group, which has been co-chaired by US and UK senior officials for a long time now, currently Andrew Bailey and John Williams from the Federal Reserve Bank of New York. That dialogue continues. It's supplemented by liaison at IOSCO between security regulators, as you would expect. And perhaps I can, as well as the process, I mean, perhaps I can pull out some of the areas where you see that alignment. I know there is a 18-month difference between the end date for the US dollar LIBOR panels and the panels for the other 4 currencies. Some people think, oh, doesn't that mean a different approach in these different jurisdictions? But if you look behind that, you can see that actually for sterling, for yen and for dollar, effectively we have the same model, which is that new use of those LIBOR reference rates is expected to stop in all of those currencies at the end of 2021, if not before. And the continuing publication of synthetic LIBOR in the case of sterling and yen, of the panel bank LIBOR in the case of dollar, is intended only for legacy contracts. So there's actually much more symmetry in approach there than might appear if you just look at the panel end dates. A second area where international coordination and alignment is, of course, especially important is in how we're approaching some of the challenges around tough legacy, where it's not possible to convert contracts. And that's where legislative solutions potentially come into play. We get a lot of questions about, well, will the legislative solutions in the UK, the New York, or federally in the United States or in the EU tie together? Might there be conflicts of law or inconsistencies? And of course, there are very careful discussions between all 3 of those jurisdictions about making sure that our approaches do line up. Of course, a feature of legislation is that it is only fully effective in the jurisdiction of the legislature, which is why we do need to have a multilateral approach to this. We've got that, so if a contract's written under New York law, it will be clear how it's treated. If it's written under English law, it will be clear how it's treated. If it's written under one of the laws of the EU member states, it's clear how it will be treated. And also, of course, there's broad alignment in the model that we are following for fallback rates. So in derivatives, of course, where you can go to the overnight rates compounded in arrears, that's locked in through various mechanisms. In some of those cash market contracts, top of the waterfall is a forward-looking risk-free rate. So a forward-looking SONIA or yen through synthetic LIBOR. Under the New York legislation, you can see the safe harbor provided for forward-looking SOFR rates and spreads. So you can see also that alignment in substance. There's perhaps one more point where I think it's worth recalling the alignment across jurisdictions, and that's the one you actually began with, Paul, on. We're not only talking about the end of LIBOR here, but also about the world beyond LIBOR and how that will be anchored on risk-free rates compounded in arrears. And if you look at those FSB materials, you will see a really common direction and intent there, that the right foundation for future interest rate markets is these overnight RFRs. And that's for lots of good reasons, not least amongst those that's where we have the most active, reliable underlying markets full of ample transactions from which to create really robust benchmarks. And I underline that because although, of course, we are all seeing those overnight RFRs getting really firmly embedded across markets, either already in the case of the bond markets, which many of you are active participants in, or in derivatives, where of course we know that all those cleared swaps and all those contracts where counterparties have signed the ISDA protocol, they are all going to become SOFR, SONIA, TONA, SARON contracts and so on. So we know that's happening, but in some jurisdictions there are still debates about whether there should be a space for so-called credit sensitive rates. And I use that label carefully because I think there's a strong argument that it's, to a degree, it's not the whole truth and nothing but the truth. In fact, those rates, because they are derived from transactions in commercial paper and certificate CD markets, in fact, they're also very heavily influenced by liquidity rather than credit. So they can behave in some particular ways when liquidity in those markets is under stress. And of course, those stress events are real, as we saw in March 2020, when all those credit sensitive rates, including Libor itself, also influenced by CP and CD market transactions, spiked quite significantly. So those are rates which carry quite significant risks for those who are paying interest at those rates, if you like, have a sting in the tail that can emerge in a crisis situation. So overnight RFRs, that common anchor point for the future across all the jurisdictions involved in this initiative.
Nate, Edwin spoke about international coordination and alignment from the UK perspective. How do you see it from a US perspective?
So I think the international alignment, as Edwin said, is vitally important. The transition away from Libor really is a global financial stability issue. And so work related to the transition has been coordinated extensively at the international level, including by the Financial Stability Board's official sector steering group, which, as Edwin said, is chaired by the Governor Bailey in the UK and New York Fed President John Williams. This work remains a G20 priority, and the OSSG regularly meets to facilitate international engagement on the Libor transition. So I think it's very clear that official sector authorities around the globe see coordination and alignment as an important objective. And I think you can see that through the major announcements that came out in the last 6 months. Those reflected coordination between, the IBA, UK authorities, ISDA, US regulators. That was all put together because we know how important it is to have clear messages that are coordinated. And as Edwin said, we're keenly aware of how the jurisdictions are thinking about the toughest legacy contracts. Again, those that don't really have an effective means of falling back, and how the fallback to risk-free rates will work globally.
The FSB roadmap, Roman, you mentioned. Could you give us a Swiss perspective on the importance of international coordination and alignment across the transition globally?
Of course, I don't have much to add to what Edwin and Nate have already said. I mean, the OSSG is the key forum, and it's going to remain that way. We are obviously part of that. We're very actively involved in the international discussion. A point that I tried to make on previous panels as well is there is a lot of coordination going on, but it doesn't mean that we necessarily have to end up with the same solution in each of the market. I already touched on the topic of derivatives-based forward-looking term rates. Nate explained that very clearly. In our case, that's not going to be an option, simply because of the lack of deep and liquid derivatives market. So our national working group has been very clear from the beginning. Everything has to be based on a compounding approach. That's going to be different compared to other markets. A similar example is the choice of the RFRs. So some of them are secured, some of them are unsecured. Always based on the particular circumstances in each market. So is that a problem? I would say clearly no. Different situations require different solutions, and all of these solutions, they are similar enough. And I think market participants will be able to cope with that. So international coordination is important, but it has to mean that we end up with the same solution everywhere.
Thank you. Edwin and Nate and Roman have all emphasized the importance of international coordination and alignment. Please, could you give us an EU perspective on that, particularly from the ECB's point of view?
Of course. Well, I mean, I can only echo and underwrite the importance that the previous speakers attached to international cooperation when dealing with an inherently cross-border issue such as interest rate benchmarks. And of course, the ECB is also a member of the OSSG, a committed and active member, and we will continue to be active there. But maybe to complement what has been said before, I'd like to make two specific points. The first one refers to European Union experience, and in particular, the approach taken by the official sector. And I just mentioned before that the EU benchmark regulation gives the European Commission powers to designate a statutory replacement rate also in the case of discontinuation of a third country benchmark, such as the Libor. Now, what I'd like to mention in this context is that the Commission would not do so in isolation from what other authorities are doing. In fact, the regulation itself compels the Commission to take into account available recommendations made by the central bank responsible for the currency area in which the benchmark rate is being wound down. So the aim of international alignment is clearly not only recognized, but I would say institutionalized and formalized in this sense. And in the case of the consultation for the Swiss franc Libor that I mentioned before, the recommendations of the Swiss National Bank and the Swiss National Working Group will be duly taken into account. The second point I'd like to make is a more global one, and in fact refers to the role of the private sector. And given the host of this panel, I'd like to refer to the global market associations as a key facilitator of global coordination and alignment. And if I can give an example, ICMA is a member of the working group on euro risk-free rates, but it's also a member of similar working groups in other jurisdictions. And this is helpful not only because it allows ICMA to share its expertise in the working group discussions, but importantly to facilitate the exchange of information across borders and help address issues in a consistent way. And in this context, it's also important to mention that it is relevant for this information to flow also outside Libor jurisdictions, where the level of awareness on the issues may be lower. And here again, and I close with this, ICMA and the other international market associations can play an important role.
Final question, Edwin. What messages would you want to leave with the market in the run-up to the end of this year?
Thank you for that question. I think the messages probably are a bit different for some of the different markets. On the UK side, what I would urge is that for those of you with legacy Libor transactions, don't sit back and rely on all the issues there being solved for you by public authorities. In the end, this transition can only be completed through action by market participants, and you will need plans to deal with those legacy transactions in due course. So the earlier the better, but as I've mentioned, synthetic Libor, for example, is not an indefinite solution. And then I think when we look at some of the other jurisdictions, and particularly that very large dollar market, now is the time to get on the train towards building the liquidity of SOFR in swaps and futures markets. It's clear that it is going to be the basis for those markets in the future, but now's the time to be making sure that you're a part of that as liquidity begins to switch decisively from Libor into SOFR.
Thank you, Edwin. And Nate, what messages would you like to leave with international capital markets?
So I guess I'd leave people with two messages. One, the end is near, no new Libor. And two, never again. So on the first point, I think it's pretty clear now. You have supervisory guidance that says no new Libor by the end of 2021. So market participants should really be taking action well before end of 2021 to make sure they're ready, that they have the capacity for entering into contracts that use robust alternatives to Libor. And that's exactly why the ARC has recommended SOFR. In the US, that supervisory guidance is clear, and it informs banks to be moving away from new LIBOR contracts as soon as is practicable, and in any case by the end of 2021. So the second point I would make is never again. And this is really that the transition away from LIBOR has been tremendously costly, and it's enormously complex. This is, approaching a decade-long effort. And as we approach the end, everyone's feeling the pain of the transition. It's very challenging. We don't want to go through this again. As our CEO at the New York Fed has said, we need to have a strong foundation for a post-LIBOR world. He gave remarks recently alongside Governor Bailey, and they both laid this out very clearly. I think the market's learned a lot about what it takes to have strong reference rates over the last decade. You need a reliable administrator that follows the IOSCO principles. Of course, that's a given. But what LIBOR taught us goes well beyond how a rate is governed. Over the years, LIBOR has undergone many changes to its design and construction, but it's still fundamentally flawed. The short-term unsecured bank funding markets, which LIBOR seeks to measure, like bank CP and CD markets, have withered up since the global financial crisis, and they can dry up completely under stress, as we saw early last year, as Edwin mentioned. So as the ARC and other best practice committees have emphasized, it's important to know your reference rates, not just whether they assert that they are IOSCO compliant. Take a look at that IOSCO compliance regime. Take a look at the public disclosures around it. Examine the robustness of the markets that underlie those reference rates and how they will weather in a storm. To state the obvious, I don't think anyone wants to be back in a position where we have extensive use of reference rates that are based on fragile markets like we did with LIBOR. It's thus unsurprising that the ARC selected SOFR as its preferred alternative to LIBOR. It's based on an enormously deep and liquid market, and it can be used in all sorts of products, and it's available right now.
Thank you, Nate. And Roman, what messages would you like to leave with the market, particularly the Swiss market, but also more internationally, particularly in the run-up to the end of this year?
Yeah, I mean, as we heard before, I mean, we're clearly in the end game. LIBOR is going to disappear for most currencies by the end of the year. I remember we had a couple of those panels in the last few years, and one of the main messages was always market participants have to be prepared for a world without LIBOR starting in 2022. Now, this is obviously no longer just a possibility, it's a reality. Fallbacks are very important, also as mentioned by my colleagues already, but we've also always said it shouldn't be the primary means of the transition. So it's still important before the end of the year to move as much exposure as possible from LIBOR-based products to RFR-based contracts. I think that's an important remaining step. As far as I'm concerned, it has been a tremendous amount of work done in the various jurisdictions. I mean, this is truly a once-in-a-generation effort. I mean, hopefully it's a once-in-a-generation effort. I mean, Nate said it very well. I mean, never again. That's definitely the major issue here. But there has really been a lot of work done. So from my point of view, it's very important that we continue to push hard during the next 7 months in order to make sure that we'll have a smooth transition.
Thank you, Roman. Finally, Thomas, what messages would you like to leave with international capital markets?
Thank you, Paul. Well, as previous speakers mentioned, benchmark reform is now a reality after a long and a costly and painful journey. And the question is no longer if there will be an end to LIBOR and to EONIA, and not even when will this end be. We have full clarity on the end date for both. The question and the focus needs to be on continuing the work to ensure a smooth transition to the new benchmarks. So for market participants, this, in my view, means 3 things. First, to ensure legal and technical preparedness for the termination of EONIA and LIBOR. And that means more specifically to review, renegotiate, or terminate to the extent possible contracts that reference the old benchmarks. And also to prepare and test your trading, settlement, and risk management systems to accommodate these new benchmarks. Secondly, the topic I mentioned already before, fallback provisions. They're important, and in fact, they are a legal obligation in the European Union. So review your contracts, even for benchmarks that are not scheduled to be discontinued, such as the Euribor, and ensure that they include adequate fallback clauses. And for Euribor fallbacks, market participants, in my view, would be well advised to take into account the recommendations published earlier this month by the Working Group on Euro risk-free rate. And third and final point, I would encourage market participants to actively embrace the arrival of risk-free rates, which, as previously mentioned by other speakers, are here to stay and are the way forward. Inertia needs to give way to a more proactive attitude. We're 7 months from the end of EONIA, and far too many new financial contracts, for instance, in OIS transactions, still reference it, despite the fact that it is already indexed to the Euro STR and not independently produced. So use risk-free rates in your own daily business, develop and offer products that are based on these risk-free rates, and actively familiarize your clients with them. Thank you.
Thank you. That's very helpful, Thomas. Thank you for watching this official sector risk-free rate panel, and thank you to the panelists for joining us.